Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Colossal AI bet. Amazon joins big tech spend, planning to put $200 billion into data centers and equipment this year, sending its shares plummeting after hours. Walking away, Rio Tinto scraps plans to buy Glencore, derailing a merger that would have created the world's biggest miner. And at the table, Iran and the U.S. are scheduled to meet in Muscat this morning for key nuclear talks. It's just on 9 a.m. across the Emirates. I'm Joanna Bersachi in Dubai. Well, it has been a roller coaster ride for global markets, and actually another day of declines yesterday for Wall Street. Just to give you some perspective, the S&P closed the session 1.2% lower, its third straight daily decline. So back-to-back losses here. The Nasdaq down again another 1.6%. This is its biggest drop since Liberation Day last April. So we're really seeing a bit of a reevaluation of some of the winners and the winning trades in the past couple of days, particularly as they pertain to the tech sector. And speaking of tech, Amazon earnings came through, huge capex spend figures for this year that spooked the market out. And in extended trading, Amazon is also trading down 11% too. So there is a lot going on there. Today, you can see S&P futures down about 0.5%. I will tell you, at one point, it was a little bit worse going into the Asian session. So we've recuperated a little bit of the losses, some support coming through, but still negative on screen there. Risk off. 10-year yields in the U.S. down at 4.18. We rallied about 8-9 basis points yesterday, also keeping in mind not just the risk off sell-off, but also we had some weakish data come through in the U.S. labor market, and there the job openings have slid to the lowest since 2020. So perhaps some cracks are beginning to emerge in the U.S. economy. That is pushing yields lower. Brent in focus once again today. We are up 0.6%, just shy of $68. Obviously, those negotiations between Iran and U.S. are going to be key for where we go from here. We will talk more about that on the show. And then Bitcoin, at one point, we got as low as $60,000, essentially a halving of where Bitcoin was at its peak back in December. A little bit more, actually. I think we're down more than 50% now. But around $60,000, you saw a bit of support come in. And actually, just looking at the broader impact on markets, once that support came in, you saw support for broader risky assets. But here's the thing. Let's switch this over. Here's a really interesting chart that my colleague Dan Curtis and I were discussing this morning. And take a look at this. Who would have thought that software and Bitcoin, and look, this is going back to 2024, I'm not just talking about the last couple of months, have pretty much been trading in tandem. So what does that tell you? Perhaps that tells you that the reason people have been investing, quote unquote, or putting money into Bitcoin is because it's a supercharged cyclical play, not a hedge, but essentially a very levered bet on all of the other S&P AI bets that are going on. And now that you're seeing a recalibration of some of those software stocks, you're also seeing Bitcoin come off as well. So a really interesting chart there, and one that I wanted to flag, the very strong correlation between software as a service and Bitcoin. Okay, with that, let's also check in on how markets in Asia are faring today. Min Min Lo is in Hong Kong for us. Min Min.
Hey, Jomana, yes, to your point, the heavy selling among the tech stocks and the software stocks in the U.S. really sort of translating over to declines in Korea as well. The Kospi down about 2.8%. It's already paired earlier losses. At one point, it was losing as much as 5%. Even the Kosdaq, the smaller cap tech companies as well, also facing heavy losses. Of course, the big companies, Samsung, SK Hynix, down by about 3% or so. This is the benchmark is set for the first weekly loss this year. So that tells you how much the sentiment has really sort of really unwounded here in Asia. But you take a look at what's happening in China as well. We're watching Hang Seng Tech. It's again, we are on bear market watch because we are, I believe, close to 5,346. That is the level to watch. We're just 30 over points from there. It's down 0.5%. We're seeing all the big tech names like Baidu, Alibaba, Tencent, as well as these software names like Kingsoft, Kingdee, all pointing down. The only exception is really the EV stocks like NIO, for example, provided profit guidance that was higher than expected. Vehicle deliveries in January as well, very impressive. So that's a sector that's in the green. It's up 8% today. Really impressive and really defying that stock route, especially in the tech sector here.
Min Min Lo in Hong Kong, thank you so much. Okay, let's talk more about what happened with Amazon. Shares have sunk, or shares sank after the company announced plans to spend $200 billion this year on data centers, chips, and other equipment. Four of the biggest U.S. tech companies together have forecast capex that will reach about $650 billion just in 2026. It's eye-watering figures there. For more, Bloomberg Asia tech correspondent Annabelle Jewelers joins us from Hong Kong. So Amazon spending plans, $200 billion. Tell us more.
Yeah, it's a really huge number, essentially, and one that investors are very nervous about, and that's why you saw such a sharp sell-off in late trading for the company. $200 billion, I want to put that in more context here because spending for 2025 was $130 billion. That was already a very significant number for the company. It was anticipated to rise to $150 billion this year by analysts, but $200 billion essentially completely blows it out of the water. Now, the CEO, Andy Jassy, is obviously aware of the market pushback on this, and he again made that case, the justification for why it's necessary. He is saying that it's going to go predominantly to the AWS unit, and you are seeing some stronger sales there. I mean, we saw AWS revenue, for instance, rising 24% rather to near $36 billion in the latest period. That was better than what was expected. But it is still something that's going to be weighing on company profits moving forward because Amazon's forecast operating income in the current quarter of up to $21.5 billion, but between 21.5 and to the downside to 16.5 billion. Actually, Wall Street analysts were looking at 22.2. So again, just falling short of that. It's clearly having a bearing on the business, and that's why you saw such pressure. But to your point around that combined selling, it's certainly a narrative we've seen for Microsoft, Alphabet in their numbers as well.
Yeah. Okay. Let's also talk about the big disruptor this week, Anthropic. So they've just released another new model days after they released the model targeted at legal services. And that was the catalyst for a lot of the declines that we saw in some of these software makers. What is the latest model targeting?
Yeah, so this is just to make that distinction, I guess. Yes, so the Claude co-work is what caused a lot of concerns this week about disruptions to the legal services industry, possible ramifications for other industries, and why we've seen such big selling pressure in software stocks as well, or another reason. So that is an AI agent product. What has been released overnight is updates to the foundation model, which is the Claude Opus foundation model with a new iteration at 4.6. Now, what the company is saying is that this model, Opus 4.6, has the capability to perform certain financial research, other work-related functions. And so they're saying, the company, that essentially it can scrutinize company data, regulatory filings, market information, come up with very detailed financial analyses that would normally take a person days to complete. So that's what the business is saying, or Anthropic is saying 4.6 can do, or Opus 4.6 can do, and also carry out other work-related functions. And we did see a market reaction of that, particularly hitting the financial services companies, because there is that concern about these sort of legacy business models. Do they survive when you've got AI models that can also do similar sorts of functions and are more suited or more adept to specific business needs as well?
Well, thank you so much. Annabelle Jewelers, our Asia Tech correspondent. Well, the market is essentially still reeling from the latest releases from Anthropic throughout the course of this week. But equities and cryptocurrencies have regained a bit of stability after those early losses in the Asian trading session, indicating that perhaps selling pressure may be easing following those steep declines in U.S. tech stocks that I was talking about at the top of the show. For more on markets, we're joined by Deepak Mehra, Chief Economist at Commercial Bank of Dubai. Well, it's been a couple of days of market reckoning, I would say. But the interesting thing, I think, is the reason we're selling off so much in AI-related stocks is because AI seems to be working, not because it's not working. So that there actually is proof that all of these models and the big spending is beginning to yield results. But unfortunately, it means that, a lot of these existing businesses now have a lot of competition.
Yes, Jamara, fully agree. So finally, the market agrees that AI will have an impact, and it is working, and it will really disrupt certain things. It will benefit certain other industries and players and so on. What is a little confusing is, why is the market then questioning CapEx? If AI is indeed working, then the hyperscalers who are increasing their capex know exactly what they're doing. It's not as though they are not aware of opportunities that they can see. In fact, if you look at their latest results, the quarterly results have been the best in several years. And where cloud computing requirement continues to grow between 35 and 45, 48% if you look at any of these hyperscalers. So in that case, capex will yield results, except they will be disruptive for certain industries, and they'll be very beneficial for others. That will be very difficult to figure out, and I think that leads to the confusion.
This is what I was going to say, right? Then how do you go about picking winners and losers? It's such a strong theme that's been driving markets.
Yes.
How do you discern what's going to win and what's not going to win?
So I think there are 2-3 opportunities which are very clear. And the sell-off, if this persists, gives us more opportunities. Remember, these sell-offs come normally once or twice a year. If you look at 45-year history, we have, on an average, 14% drawdown, intra-year drawdown, and yet we've delivered 11-12% per annum of returns on S&P. So this could be a great opportunity, except we have to be careful this time. So one, the hyperscalers, which have multiple sources of revenues, multiple drivers of business.
And core businesses.
And core businesses and pricing power. They will, of course, do well, whether it's Microsoft, Amazon, or Google. The second possible opportunity could be the mega caps that do not have much AI exposure. So I would pick up Apple over there, correct? So it seems to have missed the AI trade, but yet it has 2.2 device users around the world consuming AI over its devices.
Though it underperformed relative to
yes, but it has very little exposure to direct AI. It doesn't need to do
like
CapEx.
as a defensive tech player.
Correct. It's a defensive tech play. It doesn't need to invest on CapEx to deliver AI. And for the private investors, I think the best thing to do is what we advise our customers to do is stick to the tech index. Because it's very difficult to figure out winners and losers. The index will do well.
When in doubt, just buy the NASDAQ.
Absolutely.
Instead of
buy triple Q.
trying to be a hero, trying to figure out Okay, I take your point there. At the same time, so we talk about the big route that's been going on in AI, but then you have the labor market jitters too, and I think some questions about the directionality of the Fed. Kevin Warsh appointed, and then there was also a reckoning in the market because people thought, oh, actually, he might be more hawkish than we thought he was going to be. But given the labor market data seems to be softening, is that a real possibility now for 2026?
So look, this Friday's non-farm payroll data is not coming out, but we had a lot of labor market data this week. So from ADP to Challenger to weekly claims to JOLTS. Everything tells us that labor market is slowing down, but it's not collapsing. So the good news over there is that this will lead to further easing of wage inflation as we go ahead in this year. We already know that the tariff-related inflation pass-through has actually reduced. The December CPI was a proof of that. And then in the second half of this year, you'll also have a base effect which will pull it down. So a lot of things combined will give us further easing of inflation as we get ahead into the second half of the year. So the Fed will cut, whether it is Kevin Warsh or anyone else, they will have the right reasons to be cutting rates. And I think that is something that the market is missing out right now. And it's very clear. Now, with Kevin Warsh, it brings in a bit of uncertainty because in his previous life, he was a big hawk. Confirmed hawk, who opposed quantitative easing, resigned from the FOMC because of that.
And he changed his tune.
So his policies will not be clear in the first few months when he takes over, and that leads to volatility. And that is what we are seeing right now. So from a policy perspective, there will be lack of clarity for the first few months after he takes over.
Okay, fair. Deepak, thank you so much for joining us. Deepak Mehra, Chief Economist at Commercial Bank of Dubai. And coming up, Rio Tinto walks away from talks to acquire Glencore, a deal that would have created the world's biggest mining company. We'll tell you why next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Joanna Bersechi in Dubai. Bloomberg's been told HSBC is preparing to reduce or withhold annual bonuses for some bankers, adopting a more cutthroat stance on costs. Sources say the lender is also encouraging underperformers to depart following the bonus payouts in the coming weeks. This will include staff at managing partner levels. The move aligns with CEO Georges Hidri's goal to bring HSBC more in line with pay practices at U.S. peers. Saudi Arabia's flag carrier Saudia is in early talks with Boeing and Airbus over what could be its largest aircraft order ever, according to Bloomberg sources. They say the airline is weighing at least 150 narrow-body and wide-body jets as the kingdom invests billions to become a global tourism hub. The potential deal would replace older aircraft and expand Saudia's fleet. And Bloomberg has learned that China is asking state firms to pause talks on new projects in Panama. It comes after the top Panamanian port avoided CK Hutchinson's contract to operate 2 ports along its strategic canal. Sources say China has also asked shipping companies to consider rerouting cargo through other ports. And coming up, Saudi Arabia has dropped the price of its main oil grade for buyers in Asia, and a further sign that global supplies are running ahead of demand. This is Bloomberg. Merger talks between Glencore and Rio Tinto have collapsed after the two companies failed to agree on a price. The deal would have created the world's largest mining company. For more, we're joined by our metals and mining reporter, Martin Ritchie. Well, this has been going on for a really long time. I think it's the 4th time the groups have engaged in merger talks. Is this it for now?
It does look like it. Is it for now? It's a slightly unexpected result, right down to the wire, these latest talks between Rio Tinto and Glencore. We were expecting them until as late as yesterday to extend the deadline for talks. But it looks like Glencore has really put its foot down. It's saying it wants 40% or at least of the combined company, and Rio just wasn't able to counter or accept that demand. It looks like they've just decided to walk away, really within hours of the deadline where they had to either extend or make an offer. It's a surprising development in one way, but also putting together deals in the copper space at the moment is extremely difficult. Everyone knows the value of copper in future. We've seen other deals that haven't worked out. We've seen other talked about deals that haven't come to fruition. So it's part of a mining landscape where everyone kind of wants to do M&A, but it's difficult to do so. This deal has already arguably reshaped some of the mining sector in the sense that Glencore has already sold off part of its mining assets in the DRC. It's got really good copper assets in South America that are big growth targets in future. So I suppose one of the questions people are asking is, will there be a fresh bid for Glencore or some fresh interaction? BHP would be the obvious one, but there are reasons why BHP may not jump in either.
Martin Ritchie, thank you so much, Bloomberg's metals and mining reporter, following what I might say is the saga of the potential merger, non-merger of those two giants. All right, Saudi Arabia has dropped the price of its main oil grade for buyers in Asia, and a further sign that global supplies are running ahead of demand. State oil producer Saudi Aramco will cut the price of its Arab light grade for buyers in Asia by 30 cents a barrel to parity with the regional benchmark for March. It's the lowest level for the kingdom's prices since late 2020. We're joined by Bloomberg's Anthony De Paula. Well, I think, Anthony, every time you and I have spoken to Aramco, they've been pretty bullish on Asian demand. Quite interesting that they are lowering these official selling prices, and perhaps speaks to, beyond the geopolitical premium that we've been discussing around US-Iran, the fundamentals are still quite heavy at the moment for the oil space.
Yeah, Joanna. These OSPs, what they're called, the official selling prices, are kind of a complex mechanism where the oil companies on a monthly basis will apply a premium or a discount to the benchmark in the market. So we've seen in general oil prices strengthen, but what we've seen in Asia is that the refining margins, the profits that refiners are making from turning that oil, that crude oil, into gasoline or diesel, those have weakened. So that would indicate that Aramco cuts the price to those consumers because their profit has declined. So that is a bearish signal. Also indicates that the market can't take that higher price. And that is a sign that some of that glut that we've been talking about so much last year and building up into this year, that some of that glut is arriving. But we've got a bit of a mixed message from Aramco this month, because we were expecting for March, according to what the refiners and traders in the market were saying, they were expecting a much deeper cut in those prices, too, even to a discount. We're still at the lowest price for that grade. That's the biggest crude grade that Aramco produces and exports to Asia, which is its biggest market, so that's why this is significant.
Yeah.
But we're still at the lowest price since the end of 2020. So that is a discount. So that is a bearish signal, indicating, as I said, that coming of that glut. But it's not as bearish as the market has expected. So refiners will actually be paying a little bit more than they thought they would be paying in March. So that's going to be negative for them.
Okay, and speaking of potential extra supply in the region, you published a story about a BP looking for a partner to build up its presence even further in the Iraq Kirkuk field. What do you know about that? Yeah,
BP is in Kirkuk. They've got a plan to develop that field, almost doubling production from where they're at now. And they're looking to bring a partner in. So BP's setting up a joint venture company there for that. They'll bring a partner in to defray some of those costs, because that's a big capital investment. And what we've seen from BP and a lot of the other oil majors is that as they've seen their share prices suffer, they've made this move back to getting back into oil and gas production. They're looking for those resources here in the Middle East, where they're plentiful and they're available, relatively easy to produce. So a lot of these companies are getting in there, and they want to get into some multiple fields. So what they're doing is kind of selling down some of the stakes in some of those fields where they're working on to bring in some other investment, bring in some other cash, so they can do more elsewhere and add production.
Anthony, thank you so much. Bloomberg's Anthony DePaula. All right, some breaking news just crossing earnings from Societe Generale. Fourth quarter net income has come in a beat, 1.42 billion versus estimates of 1.22 billion. They plan a 1.46 billion euro share buyback, sees 2026 return on tangible equity above 10%. And in terms of the individual units, FIC sales and trading revenue came in a miss versus expectations, 435 versus estimates of 528. But ultimately, what we are seeing is a beat on net income for Societe Generale. And back in a moment, we're going to be discussing the latest with these Iran-U.S. talks. Good morning. This is Horizon's Middle East and Africa, our top stories this morning. A colossal AI bet. Amazon joins the big tech spends, but planning to put $200 billion into data centers and equipment this year, sending its shares plummeting after hours. Walking away, Rio Tinto scraps plans to buy Glencore, derailing a merger that would have created the world's biggest miner. And at the table, Iran and the U.S. are scheduled to meet in Muscat this morning for key nuclear talks. It's just gone 9:30 a.m. across the Emirates. I'm Johanna Bersachi in Dubai. Well, it's been a week of reckoning for these markets, with the S&P down around 2% for the week, NASDAQ down almost 5% for the week as a whole. So a major tech sell-off. That's been the secular theme, I would say, driving global markets. Today, as you can see, S&P futures also down 0.4%, though some stabilization coming through in these Asian hours. A lot of focus on those Amazon earnings. That stock is down 11% in extended trading. The market really spooked out by some of the big CapEx spending numbers that have come through from these hyperscalers this week, in addition to all of the new models and latest releases coming out from Anthropic with their Claude code and what that means for existing software services. So the software index has taken a massive hit this week as well. 10-year yields also at 4.18. We basically rallied about 8 basis points yesterday on some of the weak U.S. jobs data that came through. Job openings the lowest since 2020. So there's always the backdrop also of a weakening U.S. labor market in the United States right now. Brent, take a look. This morning we are actually up 0.6%, which is surprising. But again, all eyes, a lot of nervousness about the state of those U.S.-Iran negotiations that are set to take place in Oman today. We're going to talk more about that in just a few moments. And then Bitcoin, take a look here. We've actually rebounded. At one point, we got to $60,000. We've rebounded slightly, up 3.8%, but still a massive rout in that space. We're down about 50% since the highs that we got to in December. So for all of the talk about the Trump administration supporting the crypto industry, it hasn't actually performed well. And we're at the lowest levels since Trump was inaugurated and actually since the elections. This is my favorite chart today. It just shows you that Bitcoin has essentially been tracking software as a service. And what does that tell you? It's not acting as a hedge. It hasn't been acting as a safe haven or money going into it as a debasement theme, as what we've seen with the precious metals. In fact, it's just been a levered AI bet. And with all of these names coming off in the market now, you're also seeing money being pulled out of Bitcoin as well. Okay, let's check in also on how markets in Asia are faring. Min Lo is in Hong Kong for us. Min.
Hey, Jomana, as you said, the theme today really is the tech sell-off in the U.S. It's the Anthropic story, the Amazon story. So the Kospi really is taking a big hit here. It's already given up some of the earlier losses. Now it's down by about 2% or so. We have the Korean won also under pressure because of the heavy selling. The Hang Seng Tech as well. We are very close to bear market, 5,346. We're just maybe 20 or so, 30 points away from that level. The Nikkei, though, is really going the opposite direction. We have Japan headed to the lower house election this weekend. Takaichi's ruling party, the LDP party, expected to win. So investors are scooping up. We are seeing the Takaichi effect at play here. So that's helping to insulate the Nikkei from the broader regional sell-off here. But you flip the board and take a look at what else we are watching is the silver stock, because we had seen huge moves in the commodities market. Silver in particular saw a spectacular fall, down by about 40% since the January highs and pretty much wiping out gains year to date so far. We are seeing the silver spot now rebounding to above $73 an ounce, but still some of these silver related mining stocks are suffering heavy losses, as much as close to 10% for Sun Silver.
Min, thank you so much. Min Lo in Hong Kong. Well, Iran's foreign minister has confirmed that nuclear talks with the United States are scheduled to be held in Muscat today. This as American military forces gather in the region. Joining us now is Bohl, Senior Middle East and Africa Analyst at RANE. There's something I've been trying to get my head around, Ryan, which is the fact that a couple of weeks ago, we were talking about the possibility of regime change in Iran, and President Trump literally posted, "Help is on the way." But fast forward a couple of weeks, and he seems to be open-minded about actually negotiating with that same regime that he had sent the threat to a couple of weeks ago. What's changed in the U.S.'s calculus?
In the short term, I think President Trump got his intelligence briefings. There hasn't been much optimism within the U.S. intelligence community that regime change in Iran would be a simple or straightforward task, and certainly not something that can be accomplished from the air. And they continue to counsel him that if the United States begins military action against Iran, there are a range of ways that the Iranians can respond, and it's very hard to predict the way that might go. So I think President Trump is getting a little bit of a sober moment of taking in the facts and then calculating his next move. Obviously, the U.S. has struck Iran before. The Israelis have struck Iran multiple times, and the region did not erupt into the worst case scenario. So he has to keep that history in mind as well as he tries to accomplish his ultimate goal, which is defanging Iran, turning Iran into kind of a normal country, so to speak. Maybe not a friendly country, but one that can't threaten Israel or the United States and isn't advancing a nuclear program. Kind of pie in the sky dreams, but nevertheless, that's what he's still going for.
Okay, so in your mind, you think this is about defanging, quote unquote, Iran and less about supporting the protesters on the street. So if that does happen, what concessions would Iran need to bring to the table this time around that they hadn't already made in JCPOA many, many years ago?
Well, in the JCPOA, the Iranians were still allowed some very limited enrichment capabilities, and they kept their centrifuges. There were tight inspections to make sure that they didn't amass too much enriched uranium. Trump wants all of that gone. He wants the Iranian nuclear program largely dismantled with no enrichment taking place on Iranian soil. And then he wants to tack on the same demands he had from his first term, limitations on Iran's ballistic missiles, and the end of Iran's support for its regional proxies like Hezbollah in Lebanon and the Houthis in Yemen. Those are all pretty big non-starters for Iran traditionally. It's very hard to assess right now if Iran has decided that with the protests and with this significant U.S. military buildup in the region and the lessons of the 12-day war last year, that they might be in too weak of a position to resist all of those demands. Again, you have to be in the room with the Iranians, you'd have to be in the room with their Guardian Council to really know what they're thinking at this moment, but they certainly can't be going into these negotiations believing it's a position of strength.
No, but at the same time, it possibly is, they have to be thinking existentially, and maybe this time around yielding to some of those concessions because the very survival of the regime could be at risk, and they don't want to be risking military action from the U.S. once again. So if the Iranians do actually offer concessions, what could they look like this time, Ryan?
Well, there have been rumors that they might be able to compromise on the proxies. Those are, after all, expensive, and that's a guns versus butter argument that they can take to the protest movement and say we're no longer supporting these foreign movements. But that probably won't be enough for the Americans. The missile limitations is something that the Iranians see as existential. They believe that if they get rid of their ballistic missiles or reduce them, they're simply opening themselves up to further attack, particularly from the Israelis. So that seems to still be a red line for them. There may be some compromises on the nuclear front, but because of the Trump administration's maximalist approach to the nuclear program, it would be a very significant climb down if Iran decided to offer that. So right now, it looks really pessimistic in the outlook that there will be some kind of U.S. action against the Iranians, and it seems to be more a question of what the scope and scale of that action would be.
Yeah, and just a question for you. These provocations this week, the Iranian drone flying near the aircraft carrier, you hear about Iranian vessels accosting a U.S. ship carrying oil around the Strait of Hormuz. Why are they doing that? Why are they testing the U.S.?
Well, that's exactly it. It's testing to see whether or not the United States has the resolve to maintain its positions in that area. It's also probably elements of hardliners within the IRGC also trying to see what their capabilities are within that area. They're looking to see if the Americans truly are as serious about this military campaign as Trump's rhetoric suggests. At the same time, these are relatively cheap operations where if it does provoke an American reaction, it could provoke an American overreaction, and that would generate international sympathy for the Iranians. It would make the Americans look like the aggressor if the Americans overreact to an incident like this. So they're not just testing, but they're also trying to provoke the U.S. into doing something that will shift the narrative, at least internationally and domestically inside of Iran, into the regime's favor.
Yeah. Ryan, thank you so much for joining us. Let's see what these negotiations bring in the coming days. Ryan Bohl, Senior Middle East and Africa Analyst at RANE. Thanks. Well, let's stay with the situation in Iran and discuss the economic impact with Ziad Dawood, Chief Emerging Markets Economist for Bloomberg Economics. And you and the team put out a piece, and the headline is, you actually do see a U.S. strike on Iran as likely, but a lasting oil spike is not inevitable. So just to walk us through the different ways you see this playing out, Ziad.
Right. So let's start with the likely bit of a U.S. strike on Iran. We think that's likely for multiple reasons. The first reason is that the U.S. is already or has accumulated a large amount of military assets in the region, and it's not doing that for nothing. It will probably use them for some purpose or another. The second reason, which is related to the conversation we've just had, is that there is a gap between the U.S. position and the Iranian position. Yeah. Yes, they're holding talks, but what the U.S. wants Iran to do is unlikely for Iran to deliver, and that gap is unlikely to close. And the third reason is a piece of research that my colleague Jennifer Welch has done, which is basically there's no tackle when it comes to foreign policy for Trump. More likely than not, Trump tends to follow through on his threats when it comes to foreign policy. He put all these three reasons together and gives you that a U.S. strike on Iran is likely. That said, Although it's in a region that's rich with oil, it doesn't mean that you're going to get guaranteed you're going to get a spike in oil prices. Because a guaranteed spike in oil prices requires a few conditions. It requires that the Iranian system survives the initial strike from the US, which is not guaranteed. It requires that once it survives, it retaliates in a significant and a meaningful way, not in a symbolic way. Again, not a given. And when it retaliates in a significant and meaningful way, it attacks oil production and transportation facilities, which, again, is not a given. It could attack US bases, it could attack Israel, but it may spare all facilities. So you put all of these things together, we come to our view that a US strike on Iran is likely, but a spike in oil prices, it's a risk, but it's not guaranteed.
So where does the potential closure of the Strait of Hormuz fit into that?
It's a big risk when it comes to oil. Strait of Hormuz, you have 20% of global oil supplies goes through. We've seen Iranian threats that it might happen. It's never happened before. It's unprecedented. And if that does happen, it will have an impact on oil prices. We're talking about 20% of global oil flows. Our rule of thumb suggests when you lose 1% of global oil supplies, you get 4% increase in prices. So if you lose 20%, you get 80% spike in prices. That takes oil to about $108 per barrel. And there's a question about how long that closure lasts.
Yeah.
So
that is back to what you were saying about how big a blow the regime would have sustained. Yeah.
Exactly.
Okay. How much geopolitical premium do you think is currently priced in to oil?
As of yesterday, about $3 per barrel.
It's only $3?
It's only $3,
okay.
yeah, related to Iran. So we look at basically the movement between oil prices and gold and equity prices, and we estimate that, and it's about $3 per barrel.
Yeah. Ziad, thank you so much. Really good to have you with us to sort of flesh out some of the details and movements around where oil could get to under scenarios. Ziad Dawood, Chief Emerging Markets Economist for Bloomberg Economics. Thank you. Now, U.S. President Trump has called for the creation of a new nuclear arms treaty with Russia. The existing New START agreement, which was signed in 2010, expired on Thursday. Trump and Secretary of State Marco Rubio have suggested including China in any new agreement, but Beijing has pushed back, saying its nuclear strength is not at the same level as the United States. Coming up, Japanese voters are heading to the polls on Sunday as Prime Minister Sanae Takaichi gambles that her strong approval ratings will translate into an increased lower house majority. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Johanna Versace in Dubai. Japanese voters are heading to the polls on Sunday. The lower house election is a high-stakes gamble for the Prime Minister Sanae Takaichi as she seeks to shore up her coalition's majority in a vote set to have wide-ranging implications for markets and regional security.
Just 3 months into the job, Prime Minister Sanae Takaichi dissolved Japan's lower house, calling a fresh vote for February 8th. Coming from a string of election setbacks for the ruling Liberal Democratic Party, Takaichi is aiming to capitalize on high public support and increase her majority in the more powerful lower house. Some recent polls show an approval rating of more than 60%.
I think Takaichi is really in an extremely enviable position. I mean, her support rates have been consistently extremely high, and I think that's going to do quite a lot for her in this election.
A stronger mandate would make it easier for Takaichi to push through her agenda, including higher defense spending and the largest supplemental budget since the pandemic. But the road to victory might not be straightforward. The LDP's alliance with Komeito fractured last year, ending a 26-year political partnership. The realignment injects new uncertainty into Japan's electoral dynamics. Voters, though, are more focused on the cost of living. Inflation has stayed above the Bank of Japan's 2% target for more than 3 years, while wages lag and a weak yen pushes up import cost, giving a sense of falling living standards. To ease the pressure, Takaichi pledged to suspend the 8% sales tax on food for 2 years.
Maybe it's because of the weather, but the price of vegetables, some are just shocking, aren't they? Even things like snacks and chocolate, their prices haven't doubled yet, but they've suddenly gone up quite a bit. Same with rice.
I wish they stopped just talking about tax cuts or eliminating the consumption tax during the election season and actually put realistic measures into practice.
The stakes are high. An increased majority would give Takaichi a green light to pursue what supporters call a more assertive Japan, with higher defense spending and state-led investment. But a loss of seats would be a self-inflicted wound for the new prime minister, who has said she would step down as party leader if that happens. Even before ballots are cast, markets are reacting. The yen has wavered, and the government bond yields have risen, reflecting investor unease over Japan's fiscal path.
Since October of last year, we have taken a very responsible approach to public finance, talking about responsible, sustainable, and proactive fiscal policies. We are not talking about expansionary fiscal policies, and this is demonstrated by some of the numbers that we see. So I asked the market participants to calm down.
Japanese stocks have already outperformed many of their peers as investors focus on the so-called Takaichi trade. Ariel Buzetto, Bloomberg, Tokyo.
And coming up, a stay in Cape Town could get a lot more expensive as the city prepares to hike municipal rates on properties listed on sites like Airbnb and Booking.com. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. A stay in Cape Town could soon get a lot more expensive. The city is planning to more than double municipal rates on properties listed on sites like Airbnb and Booking.com. The move comes after a boom in private tourist accommodation has driven up prices and stoked resentment amongst locals. Bloomberg's Jennifer Zabazaja joins us from Johannesburg. So how has the rise in these short-term rentals affected Cape Town's housing market as a whole?
Yeah, Jumana, it's interesting because if you take a look at Cape Town, it is, in comparison to a number of other major cities, about this issue of access and affordability. So if we zoom into Cape Town specifically, on the one hand, there is this issue of the rise of short-term stays that is contributing to the decline in inventory of some of these longer-term permanent housing. And we've seen that over the past few years. We've seen that globally with a number of major cities. But what's happening in Cape Town specifically, the decline in some of the longer-term rental market then means that there's less affordability options than for locals. Not only that, but a number of locals are just being priced out altogether from the city as a whole. There's also this added element of foreigners who are really lured to, I mean, these pictures don't do Cape Town, I think, the amount of justice that it does, but foreigners who are really lured to the beauty of the city, and in comparison to a number of the cities that they are probably coming from, are really, it's cheap relative to where they're coming from. So that's also driving up the prices. So all of this has contributed to what has been about a 30% rise in prices over the 5 years leading up to March of 2024. So as you mentioned there, it has caused a bit of resentment with locals. But as we're hearing from the mayor, he's trying to at least tackle it in some similar ways that we've seen in other cities globally.
Okay, so what is the mayor trying to do, Jen, to bring these prices under control?
Right. Well, it's interesting. If you look at Airbnb and Booking.com and compare Cape Town to some of the other cities, some of our Bloomberg reporting actually shows that Cape Town listings had more than double the amount of listings than that of Amsterdam, Barcelona, New York City, and Hong Kong. We actually found that dedicated rentals listed on Airbnb accounted for just under 1% of formal housing units in Cape Town based on 2024 there. And so what Mayor Hill is trying to do is something similar to what we saw in New York City, and that's essentially put an additional tax for short-term rentals, increasing by about 135%. That is in rate in the RAND terms, or cents per RAND relative to the property market value. And he also wants to really try to enforce property tax liabilities and ensure that those who are staying there are either staying there for longer periods of time, and if they are, then they are, enforcing and actually abiding by the tax liabilities of the city. We've seen something similar in New York City. We've also seen something similar in London. Barcelona down the line is also looking to this. But this is just really one step, right? The mayor then, and mayors globally then still have to deal with this issue of supply and also affordability for the locals.
Jen, thank you so much. Bloomberg's Jennifer Zabazaja. Now let's take a look at how equity markets are faring up. It has been a week of declines for Wall Street indices and indices around the world. The S&P futures this morning down 15 basis points. So recuperating some of the losses. At the beginning of the show, we were down 0.5%. It was even worse earlier on. So some stabilization coming through. But of course, keeping a close eye on what is happening with those tech names. The likes of Amazon trading down 11% in extended hours. The market's really spooked out by a couple of things this week. The advances from Anthropic, in addition to the huge capex spending plans that have come out of these hyperscalers. But that is it for Horizons Middle East and Africa. Daybreak Europe is coming up next.